A key differentiator between successful and unsuccessful traders is their focus. Consistently profitable traders prioritize the trading process itself. This involves focusing on strategy, execution, and risk management. They do not fixate on immediate profits or losses. This process-oriented approach is crucial for long-term success. Successful traders prioritize the execution of their trading plan. They do not define success solely by daily profit or loss. P.L. Focusing on process over immediate financial results is key. Consistent plan execution leads to long-term profitability. Adherence to the trading plan is the primary metric for success. Profit and loss, P.L., in trading is influenced by several factors. These factors include market analysis, which informs trading decisions. Effective risk management is crucial in protecting capital. Discipline is needed to adhere to a trading plan consistently. Market randomness introduces an element of unpredictability. Traders can directly control their trading process, but not market outcomes. Focusing on the trading process can significantly reduce stress. This focus helps traders concentrate on aspects they can directly control. Heightened control reduces emotional reactivity during trading. By managing controllable factors, traders minimize stress from market volatility, focusing solely on profit and loss. P.L. can trigger strong emotional responses. These emotions often include greed, which can lead to excessive risk-taking. Fear is another common emotion, potentially causing premature trade exits. Such emotionally driven states frequently result in poor trading decisions. Examples of poor decisions include overtrading, increasing market exposure beyond optimal levels. Another common mistake is breaking preset stop-loss orders due to emotional reactions to market fluctuations. A process-oriented mindset emphasizes adherence to predefined rules and strategies. This approach aims to minimize emotional interference in trading decisions. By focusing on process, traders prioritize rational analysis over impulsive reactions. Rules-based trading helps maintain discipline and consistency in execution. Ultimately, a process mindset seeks to improve long-term trading performance by fostering objectivity. Market randomness can lead to losing streaks, even with sound trading strategies. A process-oriented approach helps traders remain disciplined and adhere to their strategies. This focus enables strategies to be implemented consistently over time. Consistency is crucial for a strategy's inherent edge to manifest and become profitable. By sticking to the process, traders increase the likelihood of realizing the strategy's potential. Losses can be transformed into valuable feedback through careful analysis. The key is to review the decision-making process that led to the loss. Determine if the initial trade was fundamentally sound, adhering to a well-defined plan. Identify any deviations from the original strategy during the execution of the trade. This feedback loop helps refine future strategies and improve decision-making skills. Analyzing losses through a process lens enables objective improvements. This approach facilitates the refinement of the trading strategy. It allows for unbiased evaluation of each step in the trading process. Objective analysis identifies specific areas needing adjustment. The result is a more robust and effective trading strategy. Discipline can be developed through consistent focus on correct actions. Examples of correct actions include waiting for setups and managing risk. Repeatedly performing these actions builds discipline over time. This repetition transforms discipline from a conscious effort into an automatic habit. A trading process is essentially a personal trading system. This system should be thoroughly documented. Documentation should span from pre-market analysis to the post-market review. Pre-market analysis involves reviewing existing watch lists to identify potential trading opportunities. Key support and resistance levels should be identified to understand potential price barriers. Defining specific criteria for ideal trade setups is crucial before the market opens. This preparation allows traders to execute informed decisions when trading begins. Before initiating a trade, define acceptable risk parameters. Determine the percentage of capital you are willing to risk on the trade. Establish a stop-loss order to limit potential losses. The stop-loss placement should be based on technical analysis or risk tolerance. Set profit targets to define the potential reward of the trade. Clearly defined risk parameters are crucial for managing capital and emotional discipline. Before initiating any trades, ensure a state of calmness and focus. Eliminate any potential distractions to maintain clear thinking. Trading should not be a response to boredom or impulsivity. A disciplined approach is crucial for sound decision-making. Emotional control helps prevent irrational trading behaviors. Prioritize a clear and rational mindset before engaging in trading activities. Trade entry execution requires careful verification. Ensure the entry aligns with the predefined trading plan. Confirm that the entry meets all specified criteria. Adherence to the plan and criteria is crucial before execution. This verification process minimizes deviations and potential errors. In-trade management involves actively overseeing a trade according to the predefined plan. Adherence to the trading plan is crucial for consistent execution. Avoid making impulsive changes to stop-loss orders based on short-term market fluctuations. Prematurely exiting a trade due to fear can undermine the potential for profit. Effective in-trade management requires discipline and emotional control. Successful trading requires emotional detachment from individual trade outcomes. Avoid linking your self-worth to the success or failure of any single trade. Instead, view each trade as an independent event within a larger probabilistic system. Focus on the overall statistical edge and long-term profitability rather than emotional reactions to short-term results. Post-trade review emphasizes process evaluation over immediate financial results. The initial focus should be on scrutinizing the execution of the trading strategy. This involves assessing adherence to predefined rules and parameters. Profit and loss analysis should follow after a thorough process review. A process-based trade journal systematically documents each trade from inception to conclusion. It begins with detailed documentation of the trade setup, including rationale and entry conditions. Effective risk management strategies employed for the trade are thoroughly recorded. Trade management decisions, adjustments, and rationale are tracked throughout the trade's duration. The journal also captures the trader's mindset and relevant market context influencing the trade. The evaluation focuses on the initial setup and entry procedures. A key aspect is verifying if the planned setup was correctly implemented. The assessment also checks if all necessary confluences were properly weighted for. Confluences refer to the alignment or convergence of relevant factors or conditions. The grading scale ranges from A to F, representing the quality of execution. This grade reflects the adherence to protocol in both setup and entry phases. Risk management involves evaluating position size in trading. It also includes ensuring immediate placement of stop-loss orders. The assessment determines if these measures were correctly implemented. A grade is assigned based on the effectiveness of risk management practices. Trade management involves assessing the execution of a predefined exit plan. The primary focus is to determine adherence to the established trading strategy. A key factor is evaluating whether emotional influences altered the planned actions. This assessment leads to assigning a grade reflecting the quality of trade management. The grade indicates the trader's discipline in following the exit plan. Higher grades reflect consistent adherence, while lower grades signal emotional interference. Mindset documentation involves recording the emotional state experienced during trading activities. This documentation aims to capture feelings, such as confidence levels. It also notes instances of fear that may influence trading decisions. Impulsiveness is another key emotional factor to record during the trading process. Tracking these emotions provides insights into psychological influences on trading. This record helps traders understand how emotions impact their strategies and outcomes. Market context analysis involves assessing the prevailing market conditions before executing a trade. A key aspect is identifying the current market phase, trending or ranging. Trending markets exhibit sustained price movement in a specific direction. Ranging markets, conversely, fluctuate within a defined price channel. Analyzing trading volume is crucial to confirm the strength and validity of the identified market phase. Analyze profit and loss (P/L) statements within the context of a process review. Determine if the trade was fundamentally sound, irrespective of the final outcome. Assess whether the decision-making process adhered to established protocols. Evaluate if external factors unduly influence the trade's profitability.